What is up, YouTube? Welcome back to Stocks by the Numbers, and today we're taking a look at Snap Inc., ticker symbol SNAP, listed here on the New York Stock Exchange. Now, as you can see from the graphic I'm looking at here, this is a year-to-date chart. Stock is down roughly 73% from the time the bull dropped. Is it an overreaction? Is it justified? Let's find out. So it's bouncing off a low here of 934, and as you can see, it's been in like a tight upward trend here. Again, back above 12.5. However, in my opinion, I do think it's going to reverse and come lower here in the short term, but in the long term, you could potentially see some decent growth here. So we're looking at a market cap of a little below $21 billion a share, and if we come down here and look annually, you can see the company brought in about $4 billion as of 2021, so they're trading about 5.5 times total revenue as of last year, which, depending on the stock, could be viewed as overvalued or undervalued. However, because the net income is still negative, in my opinion, I have to say it is overvalued still. Now, if we look here over the years, going from $825 million in revenue to over $4 billion here over these 5 years, definitely nothing to sneeze at. The company's been grinding. They're definitely increasing their ad revenue, obviously, as we can see, and they're starting to really generate more and more business overall as a company. However, the income, again, still negative. And if we switch over here quarterly, these are the graphics. This is what long-term investors, analysts, hedge fund managers, this is what they've been looking at, which is why they've been jumping ship, right? Because after all of this time, if you come up here, look at this, founded on September 16th, 2011. Today is 9/10/2022. So almost to date, we're looking at an 11-year-old company that is not making money, right? Think about that. Now, more importantly, you're looking at a stock that was, look at this, at the end of 2021 brought in $1.3 billion and really only made $22.5 million off of that number. But if we fast forward going into 2022, you can see that not only has revenue slid a little bit, but more importantly, the net income, massive negative numbers here, and that is not what shareholders want to see. So now they're back to losing, 40 cents off every dollar. So here in the short term, I think it's going to hurt the stock, and in my opinion, it should be, right now, it should be under $10 a share. So that's really where I'm looking at. That would be my entry. If I had some extra cash and I was considering starting to piece into a company like Snap, it would definitely be under $10 a share, perhaps even lower, right? So if we look at this stock, if we switch over here to TradingView, first of all, if we look at a one-year chart, you can see big gaps down here in the last couple of quarters. You can see here this was the end of July. You can see miss on top and bottom line, and if we switch back here to April, miss on top and bottom lines. Now, going back, they did have some decent beats here. Again, this was beginning of the year, February. But, coming back here, even look, a beat on the EPS side, but a miss on the revenue side. So the company has been a little shaky and a little rocky. And if we come down here, if we look at these EPS numbers, you can see they've taken hits over the last couple of quarters, which again is something that investors do not want to see. However, look at this growth annually from 2017 here going up to 2021. Again, sub $1 billion in revenue. Now they're up to over $4 billion in revenue. Profit margin was minus 417%. Now, as of 2021, was only minus about 12%. Right? So the company is doing something slightly right. However, in my opinion, and apparently in the opinion of analysts and fund managers, they want to see these numbers be positive by this point in time. And the fact that the company is still struggling is raising a red flag. Now, recent news articles state that they're looking to trim about 20% of their workforce, which in my opinion is just going to be that short-term band-aid to try to increase their profitability numbers to make it seem, a little better than it really is. But, apparently they also had a couple of ad execs now got moved over to Netflix, so they're no longer with Snapchat. And I know I read reports about some sort of drone selfie machine that apparently they scrap. So, it seems like they're trying to find different avenues of revenue, but it's really just not working out for them. And if we switch over here, just a couple of numbers that caught my eye here. First of all, price to sales ratio, came back down to earth, sitting at about 4.5. And the price to cash flow ratio, again, as of last year was over 200, and right now it's down to 60. And we have a price to book ratio of about 6, coming down from highs north of 30 and 20. So some of these numbers are starting to come back down to earth. However, they could still, believe it or not, be viewed as potentially overvalued. This section right here is very, very relevant with a company like Snapchat. When you look at these profitability ratios, this is what I was talking about before, talking about the negative income off of their increased revenue. People want to see these numbers slowly decreasing and go positive. They don't want to see them revert and go back to increasingly negative numbers. And unfortunately, in the short term, that's what we're seeing here with Snapchat. Return on assets, as you can see, were really horrific numbers. And then here, this is 2021. As of right here in 2021, you can see it got up to single digits. Return on assets was only about minus 7.75%. And now currently you can see headed back down to minus 11%. The return on equity, same thing, steadily, slowly increasing year over year. And as of last year, minus 16%. Currently, back down to minus 26%. That is a red flag. Return on invested capital, same thing, slowly increasing, got up to minus single digits at minus 9%. Currently, minus 12.5%, right? So it seems like a slight number. However, if you look at a lot of these percentage-wise, right, return on assets going from minus 7.75% to over minus 10.5%, that's a 50% increase. This right here, minus 16% to minus 26%, that's a 66% increase. This is a 33% increase going from minus 9% back up to minus 12.5%, right? So just because it's a few percentage points, you can't sit there and act like it's not a big deal. These are the big deal numbers. This right here, this is the data showing you why Snap has been decreasing, especially over the last 6 to 12 months. Gross margin percentage, right? Climbing up over 50%, got over 55%, pulled back down to 53%. Look at the operating margin percentage, increasing very steadily year over year, getting to minus 17%, and then boom, reverting back down to minus 36%. That is over 100% increase year over year. EBITDA, which stands for earnings before interest, taxes, depreciation, amortization. This, again, slowly climbing, got up to minus 14%, now minus 29%, over a 100% increase in loss. Net margin percentage, again, climbed year over year. The company is increasing their business. However, getting the net margin percentage to minus 12% is what people were looking at for the company to break out and go and start going net income positive, especially moving into the next year, right? If you look at the scale of these numbers decreasing year over year, you would more than likely expect here currently in 2022 for this to go positive. And instead, it goes from minus 12% back down to minus 38%. These are the numbers right here again, these profitability ratios. This is what's hurting the stock. So finally, we switch over here, and if we go over to the daily here, this is stock charts. If we go over to the daily on Snap, you can see that right here, the MACD has really rose over, I'd say, the last 6 to 8 weeks. So you could say that the company potentially has a top out here, approaching the top Bollinger Band here, just got above the 50-day moving average. So in the short term, you could potentially see a pullback, potentially to the bottom Bollinger Band of sub $10 a share. RSI has risen to almost 60, so it might be time for the company to sell off. We switch over here, looking at the weekly, you can see it has an RSI of about 34.5. So long term, it could start to slowly rise with the MACD rising here coming into the month of September. However, in my opinion, again, looking at the numbers, they brought in $4 billion in revenue. They have a market cap here at this level of under $21 billion, trading over 5 times total revenue for a company that is still not net income positive. In my opinion, I still think it's overvalued. And if we switch back over here to TradingView, people always want to talk about technicals to me, and they tell me I shouldn't pay much attention to the numbers. And if we look at the technicals, you can see a big gap up here, and it looks like from about $7.15 a share. So that would be roughly, excuse me, that would be roughly what? About a 40% decrease from where we're going now, going from $12.5 down to $7 a share, which would be about an $8 to $9 billion haircut off of the market cap, which would bring it down to about $12 billion market cap. They brought in $4 billion last year, so now at $7 a share, they would be trading 3 times total revenue, which for a company that has been seeing increases negatively on their profitability ratios, in my opinion, that sounds just about correct. So in my opinion, in the short term, perhaps the next couple of months, this company, I feel, is going to continue to sell off here with their negative numbers, potentially fill this gap back down to $7 a share. Then, in my opinion, you can start to position yourself long term and take a position in a company like Snapchat. You know, again, over the years, if we look here annually, look at that. That looks really good. However, in the short term, quarterly, that looks really bad. So again, like I always say with a long-term investment, it's all about pricing and timing. You don't have to force yourself into a stock here above 12.5 just because they have name recognition, or you might use the app, or they were so high, now they're so low. Take a step back, analyze some of these numbers before you jump into the water. Why start to buy shares above 12.5 when you can buy shares for under $10 a share? Right? So just give it some time. In my opinion, I think it's going to start to pull back, even if it doesn't fill this gap, right? I mean, wouldn't you want to buy shares at $8.5, $9 instead of $12.65? That's basically the point I bring to you guys when I make these videos. When it comes to long-term investments, it's all about pricing and timing. And again, not knocking the company as a whole. However, investors and fund managers are upset. They want the company to be net income positive. They're laying off 20% of their workforce. They just scrapped their Pixie selfie drone, and losses are widening. So in the short term, it's going to remain rocky and volatile, in my opinion. In the long term, you could really see this potentially turn around. And even if it fills this gap here at $20, $21 a share, remember, getting in here, you're going to make about 80%. Getting in at $7.15 potentially at this gap fill, and you have the potential to make about 200% if it gets back to 21. So just a couple of things I wanted to throw at you guys. Keep all that in mind. Once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually very quick to reply. I want everyone to have a good weekend, and I know markets are very rocky and uncertain and volatile. So like I always say, moving forward, I wish everyone success. I hope everyone makes a couple of dollars, and I'll see you guys in the next video.